This is assignment number 9 under chapter 14 or either exercise 14.1. We're going to be doing some adjustments to merchandise inventory under the periodic system. Matt Henry owns a business. His beginning inventory was $45,000 and his ending inventory as of December 31st was $57,000. Set up the T accounts and perform the year-end adjustment. Okay, so we already have our beginning inventory and merchandise inventory of $45,000. So we know that this is our old merchandise inventory figure. That was actually the ending inventory from last year. So what we need to do is insert our new inventory figure into the merchandise inventory account and then remove the old figure. Okay, so let's first work at removing the old figure, $45,000, and to do that, that's going to require a credit of $45,000 to merchandise inventory. We have a debit of $45,000. If we put in a credit of $45,000, then that will take the entry or the account down to zero. Okay, if we have a credit, you know we need an offsetting debit. So we run our debit through the income summary account. So now it's time to put in the new merchandise inventory figure, which is the $57,000. So we're going to debit merchandise inventory for $57,000 and then credit income summary for $57,000. So now when I balance out merchandise inventory, the $45,000 will go away because they offset one another and they equal zero. So the only thing left in merchandise inventory is $57,000. Let's go to exercise 14.3 or number 11. This is an adjustment for unearned revenue using T accounts. So it says we've sold 1,200 season tickets at $400 each and received $480,000. So our first entry into the T accounts will be to record the collection of this cash. So in A, we are going to increase our cash to $480,000, and then we're going to credit unearned ticket revenue. Remember, this is our liability account, and we've sold season tickets. We have not performed these services yet, so it is unearned. So we're going to put the $480,000 over in unearned ticket revenue. Then in B it says an end of period adjustment is needed to recognize that $120,000 in ticket revenue has been earned. Okay, so if we have earned $120,000, we're going to credit our ticket revenue for the amount that we've earned. And then we'll go in and reduce our unearned ticket revenue by $120,000. So for unearned revenue, you're going to have to know two entries. The first is for the collection of the unearned revenue where the sale occurred, and then the second one is to adjust it at year end. Okay, let's look at 14.4. We're going to be making some extensions to our worksheet for merchandise inventory. So here we're given a partial worksheet where we're shown our cost of goods sold information. And what we're going to do is enter the adjustment and then extend the accounts over to the adjusted trial balance. and over to the income statement and balance sheet. Okay, so it says that the ending inventory is actually $50,000. Okay, so we know that the balance in our trial balance is our beginning inventory. That's the one that we're trying to get rid of. That's the old one. So if we're going to get rid of the old, the first part of the entry is to credit. We're going to credit merchandise inventory for 40 to get rid of it, and then our offsetting adjustment will be to income summary. Okay, the second part of the inventory adjusting entry is to put in the new balance. So we need to debit merchandise inventory for the new balance and then credit income summary. Okay, so now we have our adjustments in. Oops. And we need to extend these balances over. Okay, now merchandise inventory, there's only one inventory. You can't take the 40 and the 50 over. Only the 50 is what remains. The 40, we have a debit of 40 and a credit of 40. That gives us 0. So the only thing remaining in the account is $50,000. In income summary, remember, the first number is the beginning inventory and the second number is the ending, and we need both of those to calculate cost of goods sold. So we're just going to bring both of those over to the adjusted trial balance. Okay, and then purchases comes over as it sits, just $90,000. There's no adjustment there. Returns and allowances is a credit of $2,000. Discounts is a credit of $3,000. And freight is a debit of $500. Remember, all these accounts are going to be used to calculate cost of goods sold. Now on our worksheet, we will take our adjusted trial balance figures and bring them over to the income statement and balance sheet. So we start with the income summary, and from income summary down, all those accounts go on the income statement. So 40,000 and 50 will just be carried right over. The 90,000, the returns and allowances, and the discounts, and also the freight. Now, anything above income summary goes on the balance sheet. So we will move our merchandise inventory balance, because it is an asset, over to the balance sheet. Okay, so apparently we've got to calculate cost of goods sold now. Okay. We need to see our income statement to do that. All right, so cost of goods sold always starts out with beginning inventory. Merchandise inventory January 1st will be your beginning inventory. If I come to my income statement, I see my beginning inventory balance is $40,000. Okay, then I'm going to start with my purchases. Purchases is 90. Purchase returns and allowances was 2,000. Purchase discounts was 3,000. So we have to reduce our purchases now by a total of 5,000. So our net purchases is 85,000. Okay, there's one little thing that adds to the cost of our purchases, and that's our freight. We'll add that back. And so our cost of purchases would be $85,500. Okay, so we started the year with $40,000. We've purchased $85,500. So our goods available for sale is $125,500. Okay, That's all the goods that we could possibly have sold to our customers for the year, everything we had on hand. Now, if we take our ending inventory figure, which is the second number under income summary, that's the December 31st balance. If we back out that $50,000, then our cost of goods sold is $75,500. Okay, so everything we had available for sale, we either still have it or we sold it. Okay, got that one done. All right, let's move on to 14.5. Determine the beginning and ending inventory from the partial worksheet. Okay, I think we've kind of established that. That's pretty easy. Just go to income summary. The first number is the beginning inventory, and the second number is the ending. Okay. All right, in this one, we are going to journalize in our general journal the merchandise inventory adjustment. So remember, we can put the adjustment on the worksheet, but it just provides a visual for us. We have to physically move it over to the general journal before we can post it to our general ledger and update our accounts. Okay, so it looks like we're going to do all of our adjustments here, and we'll start with A. Okay, so it looks like A and B are going to be our inventory adjustments. So income summary is debited for A for $45,000, and then merchandise inventory was credited for A. Okay, so remember, in that entry we're removing the old balance. Okay, B is adding in the new balance. So we're going to debit merchandise inventory as shown here for $50,000, and then credit income summary as shown here for $50,000. Okay, the next entry is C. All right, we are working with unearned revenue. So our debit is to unearned grooming revenue for $2,000. And then grooming revenue is credited for $2,000. So remember, our unearned revenue adjustment moves some of the unearned revenue liability into the revenue account. So apparently we earned $2,000 of our unearned revenue this year. Okay, D is the supplies adjusting entry. I hope you remember this from our previous chapter. We're going to debit supplies expense and credit supplies for $7,000. Okay, and E is our depreciation adjusting entry. We debit depreciation expense and credit accumulated. And then our last entry is for unpaid wages. So wages expense is debited for $1,200, and wages payable is credited for $1,200. And number 15, or exercise 14.7, we're going to enter journal entries under the perpetual system. On June 1st, we purchased merchandise on account from Bridge Builders Materials. Okay, so Under the periodic method, we would have debited purchases, but this is perpetual where the merchandise inventory account is active. So we are putting in the $500,000 in inventory directly into our merchandise inventory account. Okay, and it was on account, so that would be accounts payable because we are purchasing. The second entry, we purchased merchandise for cash for $400,000. So once again, the amount of merchandise goes in our merchandise inventory account, and this time we paid cash for it. On June 5th, we sold merchandise on account to Champa Construction for $20,000. The merchandise cost $15,000. So unlike the periodic method, when we sell merchandise under the perpetual method, there are two entries required. The first one is to record the sale at the retail price. So we have collected, so on account. So we have an accounts receivable for $20,000, and then we're going to record the sale at $20,000. So the next entry is we have got to move this merchandise inventory out of our merchandise inventory account and into cost of goods sold. So we debit cost of goods sold, at the price, at the cost of the inventory, and then we would decrease merchandise inventory because it's no longer do we have it, we've sold it, so we decrease our inventory account by $15,000. Okay, let's look at exercise 14.8 or number 16. We're going to be doing the adjusting entry for a merchandising business using the perpetual system. The two-step inventory adjustment was for the periodic system, and in perpetual all we're doing is we're just doing a small adjustment for the difference in the physical count of our inventory and what our merchandise inventory account actually shows. So in this problem, the merchandise inventory account has $350,000 in it, and the physical count shows $325,000. So we've got a difference of $25,000. Our account is too high, so to get it to agree with our physical count, we need to bring the merchandise inventory account down by $25,000, and then that difference goes into an account called inventory short and over.